Michael Burry, one of the world's most famous investors and certainly one of the greatest contrarians, is betting big on Alibaba. It is his largest portfolio position, making up 21.3% of it. But he is not alone. 7 other super investors put a meaningful amount of money into this investment. So today we are going to go through our 7-step analysis process to find out why super investors believe in this company. What is the upside, what are the risks, and finally, we are going to answer the most important question. Should we invest in Alibaba at the current price? If you were to invest $1,000 into this company 10 years ago, you could buy around 9 shares, and now they would be worth something close to $822. And this company recently started to pay dividends, so since 2014 you would get $9 as dividends. So if we add together those numbers, we get $831, and that is a loss of 16.9% over 10 years. Well, that shouldn't be a big surprise. From its peak, the stock lost almost 70%, and a lot of great investors like Charlie Munger, Monish Pabrai or Guy Spier believed it was fairly priced back then. But since that time, Monish sold all of his shares, and Charlie Munger said this.
I regard Alibaba as one of the worst mistakes I ever made. In thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a goddamn retailer.
Individual insiders, that is an X, 1.6% of the company is owned by individual insiders, and we would like to see this number over 2%. So it's not bad, not quite where we want it to be, but it's close. And are individual insiders buying? That is an X. We actually don't have any informations about insiders buying or selling the stock. And do super investors own this company? That is a check. We see 8 super investors in this group, including, of course, Michael Burry, but also David Tepper, for whom it is 12.3% of the portfolio, so a massive bet, and people like Guy Spier, Francis Chu, or Howard Marks. And are super investors buying right now? That is an X. They are mainly selling, and the biggest difference was made by Steven Romick, who closed his position by selling 1.8 million shares. Return on invested capital, that is a check at 11.7% 10-year median returns, and we want to see this number higher than 10%, so a nice return. And what do we know about net profit margin? It is a check averaging 14.9% over 5 years. But recently it is closer to 7.4%. But even so, it is much higher than the industry median, which is at 4.9%. So Alibaba is showing some serious power here. And now let's take a look at share buyback. It is an X. In the last 10 years, they issued extra 5% of shares. So unfortunately, they are diluting long-term investors. Not by much, but they are. And the debt, it is a check. It would take only 1 year to pay the long-term debt with a current free cash flow. So Alibaba is in a very good position when it comes to debt. Revenue growth, that is a check at 31.4% 10-year compound annual growth rate. And we would like to see this number higher than 10%. So such a growth is really impressive. Free cash flow growth, that is also a check at 17.9% in the last 10 years. Also very good, but nothing crazy. And earnings per share growth, that is a check at 10.4% in the last 10 years. So we are over the 10% that we are looking for, but just barely. And the reason for that is the fact that they are issuing stock. So the earnings are divided by a bigger number of shares. The dividend yield is 1%, so shareholders can expect to get 98 cents annually per every share. And the payout ratio, that is a check at 22.7%, and we are looking for a payout ratio somewhere between 20 and 50%. So this looks like a very secure dividend. 22% of earnings are distributed to shareholders and 78% are still in the company and can be used to generate growth. And what about dividend growth? It is an X because they just started to pay dividends and we just don't have any data and we don't know where it is going to go. Price to earnings ratio is 23.9. Not low, but considering how expensive the current market is, it is actually not that bad. But let's use a discounted cash flow formula to value Alibaba, and for that we will have to create 3 scenarios of its future growth. So in the low scenario, we will estimate a growth of 4% for the first 5 years, and then 3%. In the medium, 9%, and then 7%, and in the high scenario, 12%, and then 8% growth. So the low scenario is close to the predicted growth of the Chinese economy in the coming years. If we look at the structure of Alibaba Group, we see that it is so massive and so diversified that it really depends on the overall results of the country. Medium is close to the predicted worldwide growth of the industry, which is around 9.5% in the next few years, and the high one is closer to the results we saw from Alibaba in the last 10 years. So I think we are being rather conservative here, and we should be, because this is a Chinese company and there are several risks that come with that, but we'll get to that in a minute. So with such estimates, the intrinsic value in the low scenario is $140, in the medium $194, and in the high scenario $226. But now we have to apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $98, in the medium $136, and in the high one $158. And the current price is around $95. So it is all in the green. Alibaba, even in the low scenario, looks cheap right now. We have here a company with nice margins, low debt, beautiful growth, and a very attractive price. But we also have to take into account that it is a Chinese company, and that means geopolitical tension, the ability of the Chinese government to influence the company in a massive way, and the possibility of taking some liberties when it comes to financial data and accounting practices. And when we open our Stock Ranking Pro, we see that Alibaba is the 10th cheapest company we ever analyzed. That makes it very interesting. And when we sort the ranking by the growth score, we see that Alibaba is a company with the 17th best growth. Also impressive. But now let's take a look at the overview. And here we see that it is a well-rounded company, but growth is the strongest point for them. If you are interested in some other strong Chinese companies, then watch my analysis of BYD or Pinduoduo. Thanks for watching and see you in the next one.